Hello, welcome to smarthelping.com. What's going on here? I fully upgraded the e-commerce financial model. It's a 5-year model, and now it has income statement, balance sheet, and cash flow statement, as well as an inventory control to configure purchases if you do have to account for buying inventory every X amount of months. Don't forget to subscribe to the channel, like the video, and let's get into this thing. So this model, the e-commerce model I built maybe a year and a half, 2 years ago now, and it's a really I loved the revenue assumptions. Uh, so all the initial logic is all intact. The only thing that's been done is now that data has been distilled into financial statements for an output, um, including cash flow effects of potentially buying inventory every X amount of months. Or if you don't have to worry about inventory, if you're just drop shipping or just in time, you could just enter a 1 here and it would just do it every month, as you can see, and just be the same as the cost of goods sold. So that's what we got going on here. Let's go through each tab and I'll show you how the model works. So in general, it's a startup financial model. You can go through, set your own assumptions for everything and all the boxes in light yellow, and then you'll produce a forecasted financial statements. And there's also a discounted cash flow analysis, IRR, equity multiple metrics, and minimum equity requirements. So let's just go through each tab and we'll explain it. So first, you got company name. This flows to the income statements. You got the launch year. You can adjust this. Note if you do change the launch year, that will affect all the different drop downs. So make sure you go through all the yellow tabs. Anywhere where there's a drop down or a date, make sure that that's updated in concurrency with your launch year, so you don't have any errors. So then you have the exit month. So this determines when the financial forecast should stop, and you could stop it at any point within the 5-year period. And then on the stop month, if you're going to do a proper valuation, you can choose to include a terminal value, which in this case is going to be based on 12-month trailing EBITDA. If you don't want to display this exit value, that's fine. You just hit no here, and then the forecast will simply stop on whatever end month you've chosen, and all the balances and everything on the financial statements will just stop on that month, and you'll produce a forecast for that period without a terminal value, and that's fine as well. You can do that. You just enter the multiple here. If you are going to include a terminal value, this will be that valuation. Um, and that's coming from here. You've also got the ability to define how much of it's going to extraordinary income versus CapEx if you want to account for taxes. If not, then it doesn't matter, and you could just put 100% into here, and it'll just flow all the way through. So the model will solve for the minimum equity required. So when you look at cash sources here, you see traditional debt funding. So if you're going to finance any of the startup costs with a loan, you can put that loan amount in here, and then the model will solve for the remaining equity, if any, that's required. And that will flow to the cap table. And on the cap table, you can see that's here. You can define stock and basically the shares that any investors get based on their contributions. And you can define all of that in these light yellow columns. And based on those percentages, you can also see their share of all the distributions over time. And essentially, they can get an internal rate of return on their investment, a result over 5 years. So that's the cash sources, and these investor and owner equities just come from the cap table. Tax rate, you can put that in here if you want. If you don't want to see tax effects, zero it out. That's fine. And we've got a one-stop shop for all the sanity checks, so you can make sure that all the different statements are all matched up, because the cash flow at the end of the monthly detail here, if I look at the end month, should always be matched up with the cash balance at the end of the balance sheet after accounting for equity required, which this is checking. That's this check right here. Annual detail, or no, that's this one, sorry. Annual detail check against balance sheet cash flow. So all these check all the different statements and make sure that they're all zeroed out, which they all should always be. Revenue assumptions. So here you've got the main logic of the model. We are defining up to 10 different categories that you can sell, that you're selling online. Now it could be aggregate categories. In that case, you just group and do like a weighted average sales price or average sales price. And if you have less than 10, you can always just zero these out, whatever's not necessary. But you can model up to 10 different things, categories of things that you're selling. You can define the start month of each one. And then we've got a couple revenue channels. So number one, you can do ad spend. So spending money, and then you could define your average cost per sale, and that will define your signups, or that will define your sales from the ad spends, which you just divide the spend divided by the cost per sale, and that'll get you your count of sales per month in each of the years based on this input. And then the unit count will multiply against the sales price to get your revenue. So that's the first source of sales. The second one is partnerships. So here you can define the start month of each partner uh, for each type of product, when they're going to have a partner program, the count of partners to start with, and the growth of partners in each month over time. Also, you can define the average monthly sales of each partner type over time. So this grows the amount of partners, and then this shows you based on how many partners exist, how many sales are they doing per partner, how many sales is each partner doing per month over time. And then finally, last acquisition or revenue source or stream is just organic sales. And in here, simply define the start month that you expect organic sales to begin, the count of that, and you can define the average monthly growth rate of those sales in each year. And that unit count sales will then flow up again to the sales price to get your final revenue source. I really like this. It's simple, but it's also granular. You can model a lot of things with these assumptions in regards to e-commerce. Next up, expense assumptions. Here it's pretty straightforward. You've got running fixed costs. You can define all these different ones based on whatever is relevant to you. The start month of each and the monthly total cost of each row by year. There's also some costs as a direct percentage of revenue. So these would be like credit card fees, and you can find those here. You've also got commission rate for affiliate partners. So this is going directly to the cost as a function of the sales from these partners here. So from this partner activity in this section, all their sales, there's going to be a commission that you got to pay them. And then that's going to be a sales and marketing cost that goes into the financial statements based on whatever commission rate you're paying them. And then finally, you've got cost of products sold. So this is if one or more of the categories are, let's say, drop shipping or have a direct cost you can link to, you can put that cost here. Or if it's some inventory item, what's the total cost of goods sold? And then that will also be the direct source of the inventory purchases if you do have a situation where you're buying maybe 2 or 3 months of inventory at a time, or even 5 or 6 or what have you. You can enter that here on the inventory tab, and then that will space out the costs of goods sold. It'll put it into purchase groups based on how many months you're buying for, and that's based on your expected sales in that period, whatever it might be. So there's all your revenue assumptions or revenue expense assumptions. Cap table, this we already went over. CapEx, so here if you have any fixed costs or anything that you can depreciate, the first row is always for building. The rest are for anything else that you might have that's depreciable. You can put the cost basis, the useful life, in the month of expenditure here, and then that will propagate through the model. Remember, if you do zero these out, don't zero out the date because that'll cause an error in here and cause problems. So just if you're not using a row, that's fine. Zero out the data in B, C, and D, but don't zero out the month. Just leave that just a number in there. That's fine, and it won't cause any problems. Terminal value, again, here we can see the total value that we're allocating to fixed costs or fixed assets versus extraordinary income. It's just a tax thing. and this might not be relevant. And if not, zero out the taxes on the global control, and then right here, and then put this at 100%. Startup costs, these are just any initial costs that you have that aren't going to be part of the operations or in the operating assumptions. These are often legal fees, consulting fees, maybe a reserve, maybe a website design, things that just happen before kind of everything else happens to get off the ground. And then finally, you've got your debt schedule here. You can define the terms of the loan if you did put in that you're going to finance some of the startup costs. And then again, that will be automatically repaid on the end month if you do include terminal value. If the terminal value is not included, meaning this is selected as no, then you can see the amortization schedule just goes into perpetuity. But if you hit yes here, then on that exit month, it will assume that this debt remaining is repaid. Next up, financial statement. So here's what we added. So the income statement, we've got sales revenues, cost of goods sold, gross profit, margin, all your operating expense categories, and then we go down to earnings before interest, tax, depreciation, amortization, EBITDA, interest, depreciation. Then we've got any extraordinary income or net gain or loss from the sale of the business, taxable income, taxes, and net income. And these two rows here will only happen on the end month if the exit is included. Annual income statement is same as the monthly, but it's on an annual basis. All the same rows. Balance sheet, here we've got cash and inventory tracking, forecasting your fixed assets here, accumulated depreciation, total assets, liabilities, common stock, retained earnings, owner's equity, and these obviously balance. Owner's equity or liabilities plus owner's equity is always going to equal your assets in the accounting equation. Balance sheet annual, same deal, but on an annual basis. Cash flow statement, here you can see the operating activities, the cash flow from that, investing activities, the cash flow from that, and the financing activities, and then the cash flow from everything. And this flows into the balance sheet cash position, and that has to match up with everything else going on here. So the balance sheet's like a giant sanity check in itself. You got your cash flow statement monthly, cash flow statement annual to really see all the different items here. Inventory tab we went over. Executive summary is nice. This is just an overall view. I put different revenue streams up here, the three main ones, or the only three. There's only three of them. Total unit sales per year as well. Revenue, gross profit, expenses, operating expenses, total expenses, EBITDA, debt service coverage if applicable, annual EBITDA per unit sold. This is an interesting metric here. And then you've got all the different other items that affect cash flow. And then we finally have cash flow down here and cash position. I put some visuals to kind of give it some more appeal on what's actually happening. It's more digestible that way. And you've got internal rate of return here on the project level, and then investors group and owners group. Distribution, so here's your discounted cash flow analysis. So we've got the initial equity required, and then any cash flows in the following years. After that, you've got the project's internal rate of return, net present value, the investors, and the owners. So that looks good. You've got a distribution chart here. I put in some more visuals where you can see some high-level metrics of the entire forecasted period. Some really cool stuff here. Total partners over time, monthly ad spend, gross profit margin, annual cost analysis. And then over here, the monthly detail is kind of where you see all the granular assumptions come together. So this is a nice spot to see all of your different sources of revenue based on all the assumptions and how everything is calculated. Here you can see total revenues, your expenses, sales and marketing, G&A, research and development, EBITDA, debt service, other cash flow, total cash flow, and some other metrics here. And then annual detail is the same thing, but on an annual basis. And all this is dynamic based on whatever assumptions you plug in to all the yellow tabs. All right, that's all I got for you on this one. Subscribe, like the video, and oh yeah, to buy it, the link will be in the description box below. I'll see you guys on the next one.